Warren Hogan, welcome to the program. I said just then there weren't many economists picking a rise, but you did.
Yeah, we did, and we got this one right. I can't say I got the Melbourne Cup right, though.
Never mind, this is probably the bigger one. Last month was a finely balanced decision in the words of the Reserve Bank. Do you think it would have been a close-run thing this time?
Yeah, it certainly would have been. It was, it's a judgment call on their part. They're trying to do the right thing here and get ahead of inflation so that they don't leave themselves in a position down the track where they have to jack up rates aggressively. And this is good news for this economy because it shows that they're willing to take the heat, which comes by being preemptive on rate hikes. And no one minds when they cut rates aggressively like they did post-Lehman Brothers, but they get a lot of heat at the Reserve Bank when they raise rates ahead of the game. But of course, what it means is that it reduces the risk that they really have to go hard, and that's good news for this economy.
Well, take us through what the economic picture is, because it seems that the messages are quite mixed. Last month, when they didn't move, everyone said that they'll watch the CPI figure. We got that last week; it was pretty benign. House prices pretty stable. Manufacturing data pretty much in the doldrums. So, what is it that they're seeing?
Well, first of all, on the inflation figures, because I do agree, I think that was the head fake for many market economists and the market itself. But just remember, inflation is a backward-looking indicator, and the Reserve Bank's job is to look forward on inflation, and they emphasise that, and I think the market got that one wrong. In terms of the broader economy, look, momentum's actually pretty good. You know, we're getting numbers here that are showing our economy in real terms growing at around its long-term trend. Now, given what's happening in the rest of the world, that's very, very positive. But the real kicker here is this terms of trade shock, this commodity boom. That's driving our nominal economy to growth rates of around 10%. That's extraordinarily expansionary, and it'll filter through over the years ahead. And of course, that combined with the upcoming mining investment boom is going to put huge pressures on this economy. It's a good news story, but it has to be managed. And they're being forward-looking, which I said before is difficult. But of course, it's the right way to go in our view.
And they, indeed, in the statement from the Reserve Bank, the bank calls those high terms of trade a large expansionary shock.
Exactly right, it is. I mean, we're seeing in Q2, in the 3 months to June, our nominal GDP grew at a 15% annualised pace. This is China-like growth. This is India-like growth. And funnily enough, that's what we're getting in this country. We're linked into those boom economies. And this boom ain't going away in the next year, and they know that. And so they've got to get ahead of it because we don't want to spoil this good economic environment over the next few years with an inflation surge, because that will be followed by an interest rate surge. And if people worry about 25 points today, I don't know what they're going to think about 200 or 300 basis points in a year or two's time, because that's the payoff the Reserve Bank's looking at, is making sure they're ahead of the game to avoid that problem down the track.
Well, indeed, again, going back to the statement from the Reserve Bank, they talk about China and they say concern about the possibility of a larger than expected slowing in Chinese growth have lessened recently. Clearly, they don't, as you, don't see that going away anytime soon, that China boom.
No, I mean, the Chinese have got their own inflation issues and they've got to try and manage their economy, and obviously the relationship with the US is a difficult one, and we've got the midterms now to sort of highlight that. But the Chinese story is not about too weak a growth, it's about too much inflation or too strong a growth. And the Chinese are going to continue, in our view, to produce growth rates of sort of 8-9% for the next 5 years. And that's extraordinarily positive for our economy, and obviously inflationary as well.
Where does the dollar fit into all of this, Warren Hogan? Because it jumped about a cent on just immediately on the news. Is it doing some of the work for the Reserve Bank, but not much?
It's doing some, and it's doing a fair bit, I think, and it's going to have to continue to, because this is an external shock, and we're very lucky in Australia that we're a small, open economy with a flexible exchange rate. That exchange rate moves and takes some of the pressures off the economy. If the economy's weak, it falls, makes our exports cheaper and puts some inflation in the economy. If the economy's strong, like it is now, it rises and takes some of the inflation risk out. Australians going overseas is not good for our domestic economy, but that's what happens when the currency goes up. It hurts our tourism industry. So, look, it's part of the adjustment to this shock, and it will continue to rise in our view, and that'll take heat out of interest rates. We think a good mix of both the currency and rates is what we're going to see. So the currency could go to $1.10 and rates up another 50, 75 points in the next year. That's the kind of mix we're looking at. Yeah,
so you say 50, 75 basis points. I note that they describe this move as an early, modest tightening, and that's what they considered prudent. I'm guessing there's more to come. The question is how much more and how quickly?
Well, I think it'll be measured. We're looking at maybe 25 points every 3 quarters if our scenario of continued strength in the economy plays out, and that is quite measured. It might be a percentage point over the next year, but the economy is going to go from strength to strength. So unemployment's going to be falling, and of course the currency will be playing a bit of a role there. So we don't see another move next month, and look, they may even pause for 6 months. That's one of the luxuries they have by moving early, is that if things are a little bit wobbly, by either internationally or domestically, they can pause.
Of course, Warren, you work for a commercial bank, but the commercial banks, will they follow suit? The decision's only been around for about 45 minutes, but I'm guessing it's not going to take too much longer before home loan rates go up.
Yeah, look, it's not my place to say. I'm not sort of a commercial representative of the bank, but banks will move. I don't know how much by, and those announcements will still come out, but I think the debate is in the market there, and I think the CEOs have all made it clear what's going on.
Warren Hogan, many thanks for joining us this afternoon.
Thank you, Ali.
Warren Hogan, the chief economist from the ANZ Bank. And just to reiterate that interest rates, official cash rates, have gone from 4.5% to 4.75%, a move that has surprised some, though it didn't surprise Warren Hogan.